I'm appearing on behalf of the U.S. Chamber of Commerce. I've participated in the CFTC roundtable on the Volcker Rule, and my colleague Anthony Carfang has testified before both the House and Senate subcommittees on the subject as well. I'm here to represent the perspectives and viewpoints of corporate treasurers. In these forums, we've raised concerns regarding unintended consequences the Volcker Rule could cause. These include impaired market liquidity and reduced access to credit and capital, higher cost and less certainty for borrowers, potential competitive disadvantage for U.S. businesses and financial institutions, increased compliance costs, higher bank fees, a shifting of risk out of banks into other less well-regulated sectors of the economy, and capital flows into offshore markets. The true effects of this mammoth regulation will not be known until the conformance period ends. However, some problems which impact both businesses and individuals are coming into focus. It's important to recognize that U.S. businesses benefit from the most efficient capital markets in the world. Companies doing business in the U.S. operate with roughly $2 trillion of cash reserves, and that represents only 11% of U.S. GDP. In contrast, corporate cash in the Eurozone is 20% of GDP, and in the UK, the ratio is even higher at 32%. Reduced access to capital or certainty of access will require companies to hold more cash on their balance sheets, slowing economic growth. And how will companies generate more cash? Through layoffs, reducing dividend payouts that retirees depend upon, and by forestalling capital expenditures which fuel growth. Mr. Gantz did an excellent job of noting the jeopardy that the Volcker Rule places around collateralized loan obligations, but this may be only the first wave of capital formation problems that could arise. It's also noted that harmonization of the rule is needed. The Volcker Rule was written by 5 separate agencies, each with different areas of responsibility and different tools, histories, and processes for regulation and enforcement. Capital investment by business requires a stable and predictable regulatory environment. For the Volcker Rule to work and support economic growth, it's critical that its interpretation and enforcement be harmonized amongst all of the regulators to provide clear rules of the road. The real impacts of the Volcker Rule will not be known until the end of the conformance period winds down. However, we need to be particularly vigilant to its impact because currently we're under a very unusual macroeconomic scenario characterized by quantitative easing, which has pumped excess liquidity into the economy. We fear that this quantitative easing may actually mask the effects of the Volcker Rule for a period of time. But the start of the wind down of QE is underway, and the potential has already boosted long-term rates. The Volcker Rule will not be implemented in a vacuum. We face a time of unprecedented regulatory change. Corporate treasurers have to contend with looming money market regulations that could imperil 40% of the commercial paper market, Basel III lending requirements, Basel III disincentives for commercial lines of credit, and the implementation of derivatives regulations that could reduce the ability of businesses to mitigate risk and ensure affordable access to raw materials. All of these dynamics are converging in one place, on the desktop of the corporate treasurer, and their combined impact upon a business's ability to raise capital and appropriately take on and manage risk has not been fully vetted or thought through. Lastly, I'd like to draw attention to some rulemaking process and procedural flaws that raise concerns about the level of rigor that was conducted in crafting the regulations. The process to create the regulations did not permit sufficient dialogue. There was a comment period, but the nature of the regulation was so far changed that a reproposal would have been in well order. It also did not entail the required cost-benefit analysis or an assessment by the SEC on its impact on capital formation. Accordingly, we respectfully request that Congress review the procedures for rule writing, especially with joint agency rulemakings, to ensure fair procedures for input and comment and hold agencies accountable in the consideration of the impacts and the costs on the economy and businesses. I appreciate the opportunity to appear before you today on behalf of the Chamber of Commerce. The Chamber supports the passage of H.R. 3819 and respectfully requests that the bill be amended to include an exemption for CLOs. Thank you. I look forward to answering your questions.
The Chair now recognizes himself for 5 minutes for questions. Mr. Robertson, I think I just heard you in your testimony say that because of an aspect of the Volcker Rule that companies may have to build up to $1 trillion of additional cash reserves. Did I understand that correctly?
That's correct.
I got to tell you, even by congressional standards, that's a fairly staggering number. I think I also heard you say that from your experience that companies may have to downsize and lay off workers. You were here for my opening statement. I'm thinking about two constituents I have, Claudia and Joseph, who are either unemployed or underemployed. So elaborate how you come to the conclusion that these companies may have to downsize and lay off workers because of the Volcker Rule.
Thank you. One of the things that is a characteristic of our financial market is very robust capital markets, very strong access to commercial credit. So as a result, companies are able to invest, they're able to support their working capital needs through just-in-time financing. This allows them to run their balance sheets very efficiently and direct their cash toward working capital and investment. The minute that companies begin to doubt the ability of the market to provide financing for them or to manage financial risk, they're going to need to insure themselves against that. And that's going to require them to hold more cash because they won't know if they can get credit. And secondarily, it's going to require them to also hold more cash to hedge financial risks if they don't have access to derivatives and other hedging tools that are used for their activities. And basically, the comparison is between the U.S. with its robust markets and Europe and the UK, which have less robust markets.